Hi there, welcome to Kneppyinvests. Show me the money, Whisper. This was actually what I asked the company the last time I did a video on this on Whisper about 3 to 4 months ago. I was really interested in these type of SaaS companies, in fact, any type of SaaS companies, because these companies were growing at a significant rate. And when I say growing, I'm talking about revenue, not profit or cash flow. And management teams of these sort of companies were thinking along the same lines. It's all about growth in revenue. But times have changed. And the question I have for a lot of these SaaS companies, particularly for the management of these companies, are you going or do you have visions of changing with the times? It's no longer all about revenue growth. It's all about also path to profitability and cash flow positiveness. And the question I still have for Whisper is show me the money, show me that you have that vision. Now, I wasn't going to do a video on Whisper this particular quarter because it was not a good quarter for the company. The chart looks absolutely horrible. Share price is decreasing at a significant rate. And if they continue on the path they are, this company will be in trouble eventually. But there are a little bit of snippets of hope in there in the commentary that gives me hope that eventually management will see the light and they will have a path to profitability. But right now, I can't see that for Whisper, and I don't think the market can see that either. And that's why the share price of this company has fallen significantly over the past 3 to 4 months, ever since I last did a video, and ever since the share price reached a high of over $5. I think that was in July 2020. So it's all about show me the money. Show me what you are thinking about in terms of where you think the company can become profitable or even just operational cash flow positive. And in the outlook section in the commentary in regards to this March quarter results, it didn't fill me a lot of hope, but there was one little snippet that gave me a tiny bit of hope. So they talked about how they delivered another strong quarterly result by maintaining strong cash receipts. So straight away, they're still focused on cash receipts, on revenue, particularly the growth in annual recurring revenue, growth in cash receipts. But they did mention here combined with disciplined cost control. So they are thinking about cost. And Whisper significantly increased their spending over the past year. Be able to see that when I compare last year's March quarter results to this year's quarter results. So they've increased spending by a significant amount, and spending has actually risen by a higher degree than actually cash receipts growth. So this company has become even more operational cash flow negative, and that's not a good thing. And the other thing they mentioned here is the company continues to be on track to meet financial year 22 guidance, with revenue trending towards the upper end of the guidance range of 68 million. So again, it's all about revenue and revenue growing. So there's no guidance in respect to where this company is going to become profitable or operational cash flow positive, or even better yet, free cash flow positive. I want the company to give me some signs that they are looking towards a path to profitability, because if they have no thoughts about that, this company will eventually find itself in a bit of problems, a bit of difficulties. And the main reason they'll find themselves in difficulties is because the share price has fallen a lot, the valuation of this company has fallen off. And if they continue on this path of really burning through a lot of cash, the next time they have to go to the market to raise capital, it's going to be very costly for not only the company, but also for current shareholders. So I've already mentioned that Whispir is a SaaS company all about cloud-based communications platform. Every single time I do a little bit of research on this company, I go to the website and try to wrap my head around what this company does. So their three main platforms are automated workflows, message builder, and smart reporting. I have read through a few of their case studies. For instance, there's a call center, and there's a lot of calls coming into a call center. And one of the things Whispir does, it's sort of goes through all the calls coming in and filters them and takes them down its right path towards where should be going all these calls, something like that. I don't know. I will never have use for any Whispir platforms myself. So this is all about improving the efficiencies of companies in regards to how they communicate, not only with customers, but also their employees. Whispir was founded in 2002 and listed on the ASX June 2019, just before COVID-19 financial panic, where we did see the share price low, but the share price is moving towards the COVID-19 low we did see, which is not a good thing. The CEO and co-founder is Jeremy Wells. He has a little bit of skin in the game, 10.5% holding, and two of the largest shareholders in terms of funds that I do know, Regal Funds and Pi Funds, both have about 9 to 8% holding in this company. Now comes to the market cap and the share price depreciation we have seen since the last time I did a video. So last time I did a video on Whispir was around about February, and share price was $2.33, which gave the market cap to this company 274, which was pretty good, pretty high, but it was dropping at that point in time. Now, the share price is actually $1. In fact, I just look at the share price right now, it's at 98 cents. So it's even fallen even a little bit more from when I set up this video. That gives Whispir a market cap of $118 million. And that is a problem moving forward, particularly if the company continues to burn through a lot of cash, because they will eventually have to do another capital raising. I've already mentioned that in the previous slide. And the ticker code for Whispir is WSP. Now, one of the reasons I actually did like Whispir a few years ago was on occasion they were operational cash flow positive when you looked at their quarterly results. But the company has decided they will need to spend more to grow, which is not a good sign for a few reasons. That means the company becomes less operational cash flow positive or even operational cash flow negative. And if they do decide to spend more, they need to show that they are growing receipts or revenue at a greater rate than they're spending. So that's the question I have for Whispir, not only in this current quarter, but also future quarters. So let's go back 1 year ago. Now, in the March quarter of financial year 21, receipts from customers was at $10.9 million, and they were operational cash flow negative by 1.2. But that's not the whole story. They also spent a fair bit of money on intellectual property. Now, intellectual property has a lot to do with research and development. So this is an ongoing thing for all these type of companies. So that falls in the investing activities or maybe the financing activities, probably the investing activities. So that's 1.4 million. And you really have to add that to the cash burn rate in operating activities. So if you had intellectual property and the cash burn in operating activities, that meant this company burned through at least $2.6 million of cash. Now, in this particular quarter, they did raise $46 million of cash, and that increased the cash on hand from $11 million to $44 million. So the company did have a lot of cash on hand at the end of this particular quarter. The question is, because they are burning through cash, that cash on hand will fall gradually through time. So just see how this company has performed over the past year, and not all good news for Whispir. Not all good news, not all bad news either, because receipts from customers grew 9 million, so almost doubled from 1 year ago. So that's pretty good in isolation. If you just focus on the growth in receipts or the growth in revenue, things are looking up for Whispir. Unfortunately, even though receipts did grow by 9 million, the increase in spending was significantly higher than the increase in receipts. For instance, product manufacturing operating costs up 4.5 million, advertising and marketing costs up 600,000, staff costs up 4 million, and administration costs up 1.5 million. Intellectual property also increased, and that's now up to 2.1 million. So if you increase all the spending, it was higher, a greater increase than the increase in receipts. And that's why the company was operational cash flow negative in this quarter by 3.4 million. And then if you add the intellectual property, which was 2.1 million, that means they spent at least $5.5 million or burned through at least $5.5 million in this particular quarter. It was actually more than that, because the cash on hand fell from 38.1 million to 31.1 million. So they burned through $7 million of cash in this particular quarter. If that sort of cash burn continues, and there's no reason it won't continue, because so far in the 9 months to date, they have burned through $9.4 million in operations. And if you add together, or if you add the intellectual property spend, which probably would be around about 6 million, that means they have burned through $15 million in the first 9 months of this financial year. So they are still burning through a lot of cash. And with $31 million of cash on hand, and to continue through or down this path, they only have at least 4 quarters of spending before they'll have to do another significant capital raising. And if the share price and the valuation of this company keeps falling, that's going to be detrimental to this company. And because they'll significantly dilute shareholders, and it could be more costly to the company. Now, one thing I didn't mention in the last slide was that increase in spending is even though they have gone through some cost control measures, which is another worrying sign that they've brought in these measures, but still they're burning through a lot of cash. Now we go to the one thing the company is really focusing on, and that is the growth in annual recurring revenue. And this was a focus of most SaaS companies, all about annual recurring revenue growth. And it is growing. So Whispir has grown their annual recurring revenue from 36.7 million in the first half of 2020 to 62.4 million in the third quarter of this year. So that's a growth rate of 28% per year. But it's not all about annual recurring revenue for these companies anymore. It's all about the path to profitability, the path to operational cash flow, the path to free cash flow. Because if you can become free cash flow positive, that means you can grow your company organically. You don't have to go back to the market to raise capital. And that's the reason why I believe management of these type of companies need to focus on that path so they can grow their company organically. They can grow the company through acquisitions because they are free cash flow positive without going back to the market for more money, because money now is becoming more expensive, not only to the company, but also to shareholders, particularly if the valuation of the company drops. Now, it's not all bad news for Whispir. Now, usually when I start researching a company, the first thing I always look for is whether the company is growing receipts or revenue through time. I want to see growth at the top line, and then eventually I want to see growth at the bottom line, which is profit. And receipts are growing for Whispir. We already can see that in that previous slide with annual recurring revenue growing up to 62.4 million. If you divide that by 4, so roughly $15 million of receipts, but not all revenue for Whispir might be annual recurring. There could be some one-offs in here, which is why maybe the receipts in this particular quarter, the last 2 quarters, is a little bit more than a quarter of the annual recurring revenue. But receipts are growing through time for this company, starting at 8.3 million just after they listed on the ASX, now up to 19.8 million. So receipts have almost tripled over the past 2 and a bit years, almost 3 years now. This company has been listed on the ASX. A little bit of drop off in receipts from last quarter to this quarter, but you won't see receipts growing in an absolutely straight line. There will be a bit of lumpiness in here, but the good thing is receipts are growing. There is definite trend when it comes to receipts for this company. The question we have now for Whispir is, can you convert this growth in receipts to profitability? And I think even the market is a little bit wary that Whispir is on that path to profitability when you look at the chart for the company ever since February of 2021. Share price has been in a well-defined downtrend during most of this time. The reason I'm going all the way back to February is when we saw the share price of this company reach $4.50, and just after that high, we did see the share price of this company move into that downtrend. If you go back even a bit further, from February 2021, the share price actually did reach more than $5 at one point in time. So that was just after the COVID-19 financial panic. I think that high was reached in July 2020. But the share price is in a well-defined downtrend. On occasion, you will see a relief rally. We saw a pretty significant one in January or even February of this year. Share price rallied from $1.75 to $2.88. It did look like that was a possible shift in sentiment and a shift in trend of the share price. But we did not see a crossover between the 100-day and 50-day moving averages, which I do have here. And because there was not a crossover, that was not confirmation that there was a shift in trend and sentiment for me. And when that possible shift in sentiment and trend did fail, the share price kept on falling. And in fact, the share price has fallen all the way to $1. And $1 was reached about 3 or 4 weeks ago. And this is sort of proof that psychology is such a powerful thing when it comes to investing, because the share price has just stayed around about $1 for 3 or 4 weeks. And round numbers are a powerful level for most, maybe not most investors, but a lot of investors look at round numbers. And that's why Whispir has really struggled to get below $1. I think a lot of investors out there are looking at the current share price at $1 for Whispir and thinking this is cheap because the share price was significantly higher only just a few months ago. And if we see the share price fall below $1 on quite good strength, that will be a fairly bearish move. The fact that we haven't seen any sort of rally in the share price over the past 3 or 4 weeks, as soon as the share price hit $1, is a worrying sign for this company moving forward. And if we take a look at the weekly chart for Whispir from when they listed on the ASX back in June 2019, we did see the share price reach a low during the COVID-19 financial panic of lower than 75 cents for a very brief period of time. And then we saw a fairly quick bounce. And in fact, that bounce kept on going from that low of 75 cents to a high of $5.25, which was reached in July of 2020. So the share price of this company five-bagged over a very short period of time. But ever since that high, when you look at the weekly chart, the share price of this company has been falling. And right now, share price is $1, very close to the lows we saw during the COVID-19 financial panic. So sentiment in this company is driving a share price to almost historic lows. And that would be a really bad sign if the share price falls below those COVID-19 lows. And one of the reasons why the share price is just decreasing for this company is because that increase in spending has led to this company being more operational cash flow negative. The market sees this company burning through a lot of cash, and they are concerned about the future of this company. So I do believe there has to be a change in mindset of management over the next few quarters, and they need to have more of a focus on profitability, more of a focus on becoming operational cash flow positive, free cash flow positive even. And until then, I do think the share price has more to fall from here. Now, the other thing is, because of increased their spending over the past year, there is that potential that there could be benefits when it comes to receipts and revenue over the next few quarters. And if they don't increase in spending and we do see a bump up in revenue and receipts, that could be their path to profitability. But they really haven't mentioned that at this point in time. If they did mention, they do expect spending to remain level or even decrease from here, and they do expect revenue and receipts to increase from here. That would be a good sign to the market and to me that they are on the path to profitability. But I want to see that mentioned by management. We haven't really seen that yet from this team. So that's why I really want to see this company show me the money, show me you are thinking about becoming profitable, thinking of becoming free cash flow positive in the future. Don't just be concerned about growing revenue, growing your annual recurring revenue. If you can also keep a cap on spending, even decrease spending as you grow revenue, that would be the best scenario for this company moving forward. Times have changed, and this company hasn't showed me and the market they can change with the times. If you do have any questions about this company, I'd love to hear about it. If you totally disagree with me, I'd love to hear your thoughts on Whispir. If you think this company is awfully cheap right now, I'd love to hear from you. So leave a comment in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.